We now move to our discussion around the unit 3 of financial reporting and analysis. And we're going to start with talking about what is the income statement and what are the nuances of the income statement. In this unit, we are going to look at multiple kinds of income statements from a variety of companies, look at live data around those companies, try and analyze all the headers that are there in an income statement, try and make sense of all of those as we go along, right? Now, as we begin, the first thing that comes to our mind is what kind of income statements are available and what kind of companies report those kind of data. Uh, we might broadly have a very similar kind of a set pattern around income statements, but some companies or some industries might use different data points. So we're going to look at all that as we go along. So this is going to look at what are the key components and formats of the income statement. It is going to look at how do we recognize revenues and expenses. It is going to look at non-recurring items, items that do not repeat over time. They are one-time, one-off items. It is going to look at the calculation of earnings per share in the income statement. How do we calculate it? What does it mean? What's the use of that? And then it is going to look at analysis of income statements. In addition, wherever possible, we're going to look at a lot of live cases of income statements of a variety of companies and try and gauge what are all those data points that we are looking at. Right, so that's broadly going to be our construct during this particular unit. We will begin with a quick recap of what we have already done around the income statement. So the income statement or the P&L account or the P&L statement as it is called is nothing but a measure of the company's well-being and perceived value addition to the customer. It's a sort of a report card of the financial performance in a particular period, usually annual, quarterly, monthly, 6 monthly. Most commonly available profit and loss statements are either quarterly, so companies report quarterly numbers, and then they kind of combine them to give the annual numbers, right? So we already know the financial year. So if we are looking at financial year 2017, this will start in April of 2016 and go on till March of 2017. So April, May and June is Q1. July, August, September is Q2. October, November, December is Q3. And Jan, Feb, March is quarter 4. These are the 4 quarterly results that can come. So you can have a P&L statement on a quarterly basis. And then you can obviously have a P&L on the annual basis as well. P&L account is also known as P&L statement, income statement, earnings, net income, profits. All these terms are used interchangeably, and we're going to continue using them interchangeably as we go along, right? Now, what is a P&L? It gives us an idea about what has transpired during the year in terms of the business activity, right? Remember, it may have nothing to do with the cash generation during the year. In terms of business, what am I selling and what are my costs in creating those sellings? That is basically what the income statement talks about. It's a periodic statement, which means it is over a period. It is not at a point of time like the balance sheet, which is at a point of time. And it's a sort of a report card. It's an important statement because it tells us whether the business is profitable or not profitable, right? We've also seen different views of profits. We're going to recap those in a different manner now. So when we start with sales of the company, which is nothing but what the company has sold, the revenue of the company or the sales, or what is also called as top line. Why is it called top line? Because that's the first line of your income statement. So it's also called as the company's top line. Top line minus cost of goods sold. Cost of goods is the cost undertaken in basically creating that good. You remove that, what you get is gross profit. From gross profit, you remove other cash operating expenses. What could these be? Salary, it could be electricity, it could be other overheads that are there. You remove all these, you get what is called as earnings before interest, tax, depreciation, and amortization. Depreciation and amortization are basically non-cash expenses. We are going to look at these in detail now, but these are expenses that we are saying that if we buy a car worth 10 lakhs and the life of the car is 10 years, instead of taking the cost of the car as 10 lakhs, we're going to divide it into 10 years and write off 1 lakh every year. This is a non-cash expense because the cash has already gone out. That's 10 lakhs. We are only accounting it over a period of its useful life. So we are putting this 1 lakh, 1 lakh, 1 lakh. That's depreciation and amortization. When we remove that, we get EBIT or operating profit. Some geographies and textbooks call this as operating profit. Most geographies call this as operating profit, which is earnings before interest and tax, EBIT, or profit before interest and tax, PBIT. Right? There is no hard and fast rule that you call this the operating profit. If you are calling this as the operating profit, you have to call this as the operating profit for all the companies under question. If you are calling EBITDA as the operating profit, you have to call this as the operating profit for all the companies under the consideration. Then you pay interest on the loans that you have taken. What you get is earnings before tax, EBT, or profit before tax, PBT, right? And you pay taxes on that, corporate tax rate. What you get finally is the net profit, also known as the bottom line or the net income for a company, right? Bottom line, because this is the last line in your financial statement, which is the P&L account, right? That's why it is called the bottom line. So those are the various views of profit that are relevant. And if someone says, I want to know what is the gross profit, that's sales minus cost of goods sold, right? Not all companies report it in this format. So we will look at a sample profit and loss statement. The statement of profit and loss for the year ended March 31st, 2016. This is for a company called Ashok Leyland, which is basically the trucking company. They make commercial vehicles and they make trucks, right? These numbers are in lakhs, right? So they've given numbers for 2016. They've also given numbers for 2015, correct? Now, if you look at the construct of this statement, the first part is income. So this is all the revenue that you make out in the company statements, right? The second part is expenses. So these are broadly all the expenses that are there. And then you get the profits, which are first you get a profit before tax number, and then you get a profit for the year, profit after tax number, right? Those are the broad numbers. If you look at this closely, which we are going to do now, we're going to talk about each of these line items now. So let's start right at the top, which is revenue from operations. This is what is called as gross sales, right? It's called gross because that's the actual money you are making on selling something. Now, when you produce something, whenever you are producing something, there is a tax on this production. This tax that the government puts is called excise duty. If you are a manufacturing firm, you manufacture something. The moment something comes out of the factory, there is an excise duty that is put up. That's an ex-factory item. So you remove that because this has gone to the government as an expense. What is remaining is net revenue from operations. So this is the net sales value. If it is a manufacturing company, you will see excise duty. If it is a services company, you will see service tax in India at this point of time. Now we are looking to kind of move towards the goods and services tax, GST, in which case this line item will get replaced by GST for all kinds of companies, right? Once you remove the taxation component, you get to net sales. Then you have a header called other income. Now what is other income? Whatever is coming out of your business operations is revenue from operations. Whatever is non-operational in nature, is other income. For example, sale of assets may get you an income that's non-operational in nature, correct? Interest on the money that the bank deposits for the company have. So interest on bank deposits, that's non-operational. One good test to find out what is other income is if the company stops its business operations, right? Even if the company stops the business operations, the non-operational income should keep coming in. Now we don't include it everywhere for our analysis because this is non-operational in nature. The company's business operations do not really get affected by this or do not really We do not really look at those business operations in that context in terms of understanding what these other income items are, correct? So that's my sales items. Those are the different headers of sales that we see. Let's look at the cost headers now. So under expenses, broadly, the first three that you see work around the materials cost or raw material cost, right? So you have cost of materials consumed. This is all the raw material. Then you have purchases of stock in trade, traded goods, right? Let's take for argument's sake, there is, so this company is making a truck. So when you take a raw material and you convert that into a truck, that's the cost of materials consumed. That's line item 1. Let's say they have an order for 100 trucks, right? Order for 100 trucks, but they can only produce 98 trucks. So what they can do is they can buy 2 trucks from the market, put own label to those, and add that to the 98 and sell the 100 trucks. They can do that. So this is traded goods. They can buy something off the market and directly sell it. They can buy a tire off the market and sell it under their brand name. Correct? That's purchases of stock in trade and traded goods. Basically, the raw material or the item that is going into sales. And then there is a construct around changes to inventory of finished goods, work in progress, and stock in trade. We will discuss this specific item separately. For now, just assume this is a part of raw material cost. For now, that's the assumption. We will discuss this exact number at the later part of this unit. Then we have staff cost, basically employee benefits expense, salary, etc. And we have finance cost. These all will come later. Let's look at the other expenses. All other expenses are clubbed together. So this might be administrative expenses. These might be selling expenses. These might be rents. Whatever is there is clubbed under the other expenses header. Finance cost is the interest. And then we have the non-cash expenses, which are depreciation and amortization, right? Those get clubbed here. All the expenses come here. Once the expenses are taken care of, we reach to what is called as profit before exceptional items and tax, right? Now let's understand what do we mean by this exceptional items term. So anything that is out of the ordinary for a firm is called exceptional item. Usually these exceptional items would be non-recurring in nature. We will look at further detailed examples of this, but this is an exception. This is essentially a one-off item. It's happened this year. It might not repeat next year, right? That's the definition of an exceptional item. For example, they could suddenly have a loss on a particular order because of foreign currency movement. Now, this is not their business. Foreign currency movement can cause that. There could be a loss in one particular factory because of floods, for example. So they could take an exceptional loss because of that on that factory itself, right? That is what is called as the exceptional item, and that is what we look at when we are looking at the exceptional items. Once you remove those, it is not necessary that you find exceptional items every year. What you get is profit before tax, to which there is a tax expense put in, right? Now, usually your overall tax expense would be the corporate tax, but accounting concepts allow you to basically define them in terms of what is current tax and what is called as deferred tax. Deferred tax is a concept we are again going to discuss at a later stage. We don't necessarily need to deal with that right now. We'll come to that within this unit at a later point. So there are 2 or 3 items which we are going to look at in more detail. We're going to look at this item in more detail. We're going to look at other income in more detail. We're going to look at exceptional items in more detail. And we're going to look at deferred tax in more detail within this unit somewhere later, right? Once you remove that, the taxation that goes out, what you get is profit for the year, which is the final net profit that the company generates. Almost all companies will have a similar structure where you start with some sort of income, you remove what are the key expenses, and what you're left is with the profit, right? We're going to look at more examples again within this unit as we go ahead and understand the income statement in a little bit more detail. Now, all the headers that we have seen on the income statement, let's recap the statements and definitions. Gross sales is the revenue from the sale of products or services, the actual gross revenue, right? So if an item is worth 100 and there is a tax of 10% excise duty on that, 110 is the gross sales number, right? Then there is an excise duty or service tax, which we said was 10%. So that's 10 here. What is left is net sales after you remove this. So 110 minus 10 is equals to 100. That's my net sales number. After I have removed what I'm paying to the government, the final price that goes to the customer is what is the net sales number, right? Or what I make out of what the customer pays. The customer has paid 110, but 10 has to be deposited to the government straight away. What is left in my hands is 100. That's my income. Other income is income from sources other than the normal operations of business or income from investments, those kind of examples, right? Raw material is the raw material used for manufacturing the products or the services, right? Staff cost is the payments made to the staff. Other expenditure could be electricity, marketing, administration, rent, etc. that comes up. Total expenses are the sum of all of the above expenses, right? We club all these together. That's my total operating expenses that come in. Other expenses could include a lot of other things. They could include R&D expenses. They could include maintenance expenses. They could include sales expenses. They could include some sort of lease payments. Technically, lease should come somewhere else as well. The lease could be a interest payment or rental, which comes in terms of a financial lease, or lease could be the rent that I'm paying on something, and that basically comes as the operating expense that we get. So you could have a variety of these other expenditure. You could have transportation charges, right? If you transport goods from one corner of the country to another, all that is clubbed under other expenditure, right? We will again get into details of what those other expenditures could be with reference to some companies. Total expenses, sum of the above. Once you remove these, so sales minus operating expenses gives me, or cash operating expense gives me earnings before interest, tax, depreciation, amortization. Profit generated from the normal course of business. This is given by sales minus expenses. Note that this excludes other income. So far, we have not included other income here. So only the sales from ops. From that, you subtract cash operating expenses to get EBITDA. From that, you subtract depreciation. And again, something that we're going to look at in more detail. Any fixed asset purchased is not written off as an expense in the same year. The expenditure is assumed to be divided over its life. Only the value which is written off in 1 year is accounted as an expense, right? Which goes away in the first year is going to get accounted in the P&L as the expense. Then you get EBIT, from which you can pay the interest. Once you repay the interest, after this, you take EBITDA plus other income minus depreciation minus interest. Now you include the other income because other income will involve taxation, right? To get to profit before taxes, what is left? So EBITDA minus depreciation minus interest will give me the profit before tax. You have to add the other income to this because there is tax on that as well. And then you pay the tax. What is left finally is the net profit available for distribution to the shareholders, correct? Those are the major headers in any financial statement that we will typically find. Now, you will find that for manufacturing companies, raw materials will be the bigger segment. And for a lot of the services companies, staff cost will become the bigger chunk, right? So for example, if you look at a company like Ashok Leyland, and we looked at the statement, out of their total expenses of 17,37282, if you add all this, nearly 70% plus is coming from the total raw material portions, right? Whereas employee benefit is only about close to 8% or something, and other expenses are close to about 12% or something of the overall expenses, right? Bulk of it is coming here. If on the other hand, you look at a company like Infosys, nearly half of the cost is going to be salary because there is no raw material. You only have employees, and there the costs would come. So depending on the industry, these headers would have different weights for companies in their total expenses, but broadly the headers are going to be similar, right? Then we have to discuss very quickly what are income statement formats. What we saw just now was a multi-step format. The income statement usually shows gross profit subtotals. So it shows what is gross profit, it shows what is EBITDA, then it shows what is EBIT, then it shows what is EBT, and then it shows what is net profit. In a single step format, you will just say sales and keep putting all the expenses one after the other, and then finally you get to net profit, right? Then we have operating profit definitions. Basically, operating profit and EBIT may or may not be the same. In some geographies, EBITDA is considered as the operating profit, in some EBIT is considered. Remember, other income has to be excluded in this. And then expenses can get grouped in terms of variety of formats. In the format we saw, it was put in as cost of materials, cost of staff, and other costs. You could also put it in some sort of other concepts like what is the cost of manufacturing, all costs that go into manufacturing, all costs that go into marketing, and you could kind of create functional headers based on that as well. Usually the first one is more common, right? So that's the expense grouping. That brings us to an end of this particular section, this particular video. Very quickly explain what do we mean by the excise duty and explain what do we mean by other income. Thank you.